The straight line method and the double declining balance method are two different ways that a company could record depreciation for its property, plant, and equipment. Now, the straight line method is the one that's used by most companies. It's easy to apply. It results in the exact same amount of depreciation being recorded for the asset each year. The double declining balance method is a little bit more difficult to calculate. I'll show you how to do it with an example, and it's going to result in more depreciation being recorded in the early years of the asset relative to the straight line method, and less depreciation being recorded in the later years of the asset. Either way, the total amount of depreciation recorded is going to be the same, and you'll see that with the example. So let's jump into it. Let's say we've got a company called Virtual Grandpa. They acquire property, plant, and equipment for $100,000. They expect that the equipment's going to have a useful life of 5 years and a $20,000 residual value. Okay, that's also known as the salvage value. This is what they expect the asset the value of the asset to be at the end of the 5 years. Okay, so how will we record depreciation under each method? I'm going to show you the straight line method first because that's the easier one. Then I'm going to show you double declining balance, and then we'll compare the two. So we've got $100,000 is the amount of the asset, but we subtract the residual value. We don't do that under the double declining balance method. You'll see that in a minute. But we take the amount of the asset, $100,000, minus the residual value, aka salvage value, and we divide that by 5 years. So we've got $80,000 divided by 5 is $16,000. So that means for years 1, 2, 3, 4, and 5, this company is going to record $16,000 of depreciation expense each year. They're going to debit depreciation expense, credit accumulated depreciation. Okay? So the double declining balance method, a little bit more complicated. First, we have to calculate the depreciation rate, and it is going to be double the straight line rate. What does that mean? Well, when we're using straight line, okay, we've got $80,000 here divided by 5. You could also view that as 80,000 times 1 over 5. Okay, that's the amount of depreciation each year under straight line. So we take 1/5 of the depreciation each year under straight line. So under double declining balance, it's double. So we just take the straight line rate and multiply it by 2. So that comes to 2 over 5. In other words, 40% will be our depreciation rate. Okay, so let's do the calculations. In year one, the beginning book value of the asset is $100,000. We multiply that by 40% rate, which we calculated up here, and that gives us $40,000 of depreciation expense per the double declining balance method for year one of the asset. So the ending book value, remember the book value of the asset is just the $100,000 minus the accumulated depreciation. In this case, we just have $40,000 of depreciation accumulated thus far. So the book value is going to be $60,000. Now this book value carries forward, and in the next period, we're going to multiply that because the ending book value for year one is the same as the beginning book value for year two. So then we're going to take 60,000 times 40%. Okay, you don't take 100,000 every single period and multiply it by 40%. Okay, you go with the beginning book value. So 60,000 times 40%, $24,000. Notice again. By the way, also, we did not subtract the salvage value. For year one, when we calculated depreciation, we didn't say 100,000 minus 20,000. We didn't do that, okay? So we've got for year two, the depreciation expense is going to be 24,000. That's the 60,000 times 40%. So the ending book value is going to be 36,000 at the end of year two. What is that 36,000? It's 100,000 minus 40,000 minus 24,000. Okay? Now, the 36,000 ending book value of year two is the beginning book value for year three. So then we have 36,000 times 40% is 14,400. Ending book value, 21,600. Okay, so that's the beginning book value of year four. Multiply that by 40%, gives you 8,640. But here's the catch. You can't record 8,640 depreciation expense for year four. That's why I have it crossed out here. Because that, if you took 8,640 and subtracted that from the 21,600 beginning book value, you would have an amount that is lower than 20,000. But 20,000 is the salvage value. So we're only supposed to depreciate down to the salvage value. Okay. So for year four, the depreciation expense is capped at $1,600. Instead of 8,640, it's $1,600. Why? Because 21,000 minus 1,600 is equal to 20,000, which is the ending book value, okay? And we don't want to take the ending book value below the residual value, okay? So then for year 5, under double declining balance depreciation, we are already at the bottom book value, the residual value, so we don't record any depreciation at all for year 5. Okay? So that's how we do it. Now let's look at the comparison of each of these methods. Okay? So if you look, so let's say the straight line is the simple one. Every single year, we're recording the exact same amount of depreciation expense. $16,000 adds up to a total of $80,000 of depreciation, which, remember, we bought the asset for $100,000. If you subtract $80,000 of depreciation, that gets you to an ending book value of $20,000, which that's what it's supposed to be. That's what we said the residual value, aka salvage value, is supposed to be at the end of the asset's useful life. Double declining balance depreciation, we have $40,000 of depreciation in year 1 compared to just $16,000 of straight line. Okay, so double declining balance, again, is going to result in more depreciation in the early years of the asset. However, you see it goes down, right? It goes down. Year 2, it's $24,000. Year 3 is $14,400. So by year 3 in this example, it's actually less depreciation than the year 3 straight line depreciation. Straight line in year 3 is $16,000 and double declining is $14,400. Okay, and then just $1,600 versus $16,000 in year 4 for double declining and straight line. And then, of course, no depreciation, all recorded in the 5th year for double declining balance and $16,000 for straight line. So, again, we end up with the same total amount of depreciation either way. Either way, we're recording $80,000 of depreciation, getting us to an ending book value, the residual value, of $20,000 at the end of the asset's useful life. However, double declining balance is taking the depreciation faster. We're reducing it faster. We're getting $40,000, $24,000, right? We already took $64,000 of depreciation in the first 2 years, where it's just $32,000 for straight lines. So that we see that double declining balance results in more depreciation in the early years of the asset and then less depreciation in the later years of the asset. But either way, we end up taking the same amount of total depreciation over the asset's useful life.